Welcome to today's Property Pulse, our weekly fireside chat in the real estate success community. My name is Simon Buckingham. I am joined by Tony Lambrianos. Welcome, Tony. Great to have you on board.
Hello, Simon. Hello, everybody. Good to be with you.
We are today going to be talking about the latest inflation numbers, the inflation scare that's come out this week, and what that means in reality, and unpacking that a little bit. So the latest inflation figures dropped yesterday, and within about 5 minutes, the internet was on fire with hot takes and everybody predicting what's going to happen next with interest rates as a result, experts deciding if rates are going up forever or if they might be on hold, or a few people suggesting they could even go down. So today what we want to do is push all that hype and noise aside and try and take a look at what the numbers actually said, what the RBA is likely to care about when it meets next week, and what that changes, if anything, for next week's rates decision that's coming out that we'll all be paying, no doubt, very close attention to. Tony, let's take a look at then the numbers that matter. So headline CPI, the Consumer Price Index, that is what gets the most press in the media, the headline CPI jumped, but the underlying measures didn't. So the real question, is this really a big inflation problem? Is this just a petrol issue? What's going on? So, Tony, can you give us a little bit of a rundown on what the key numbers actually did show?
Thanks, Simon. Basically, the headline inflation was 4.6% for the year to March, up from 3.7% previously. This is a big rise of around 1.4% for the quarter. But interestingly, the underlying inflation, the so-called trim mean, was unchanged at 3.3% for the year. Trim mean for the quarter was actually around 0.8%. So, Simon, how does the 0.8% sort of compare to previous quarters?
Yeah, see, that's an interesting one. So, as we've said before, but perhaps for those who might not be so familiar with it, there are really two measures of inflation that get looked at. There's what's called the headline inflation, which is what's happening right across the whole basket of goods and services that are measured in terms of price movement to determine the inflation rate. And then there's the Reserve Bank's preferred measure, which strips out the really volatile items, so things like petrol, things like travel, get stripped out, and they concentrate just sort of on the middle 2/3 or so of prices and what's going on with those. And that gives them what they call the trimmed mean or underlying inflation. And that's really what they focus on. Now, that, as you said, Tony, that went up, 3.3% year on year and 0.8% within the quarter itself. When you take a look at that and how it's been traveling over the past 3 or 4 quarters, it's interesting to see that for the past 3 quarters, it's dropped for the quarter from 1% to 0.9% to 0.8%. So that's actually been trending down.
Yeah.
And so whilst the year on year measure is the same this quarter as it was last quarter, and that's due to what was in each of the 4 quarters to make that up, the way it's been moving more recently has been a slight easing, which kind of suggests maybe the underlying inflation, outside of all of these issues with the Middle East crisis and petrol, underlying inflation kind of peaked and it was starting to ease back and has been easing back a little. So that could be something interesting that the Reserve Bank hopefully pays attention to in the upcoming meeting. But of course, we had this big noisy spike in the headline inflation, and that's what's got everybody up in arms at the moment. So that jump from annual inflation of 3.7% to now suddenly annual inflation of 4.6% on the headline number. Maybe it's worth us digging into what's caused that spike a little bit, so that we're all on the same page around that. And no doubt everyone would recognize that that's largely due to petrol prices, to fuel prices. So fuel is up, I think it's over 32% for the month of March. So that's the strongest monthly increase since 2017, according to the Australian Bureau of Statistics. So that's a really big jump in petrol prices or fuel prices generally. But it wasn't the only thing that pushed up headline inflation. There are a couple of other things. And one of the big parts of the CPI, of how we measure inflation in this country, is this category called housing. Now, housing is a bit of a weird one because it doesn't actually include established housing. So it's not about what's happening to median house prices around the country or anything like that. It focuses in on a few things, and it actually includes energy. So things like your electricity bill is part of the housing category. So there was a bit of a jump a year on year in housing as well. That's up 6.5% year on year. And that's largely driven by a couple of things. One is electricity. Electricity prices, because the rebates have ended, electricity prices are up like about 25% year on year because of that. But it also includes the cost of buying or building new dwellings. So new dwelling prices are part of this measure, and the cost of those new dwellings is up 4.5% year on year as well. And that's a big contributor. Rents are up almost 4% year on year. So those things are all part of that measure, and that's why it pushed up the housing category. But that housing category is about 20% or more of the overall measure of inflation in this country because of how it gets weighted. So we put a lot of emphasis on that figure. These are the things that are driving into the headline inflation, not so much into the underlying inflation. Whilst headline inflation has jumped largely because of petrol prices, electricity, and building costs, underlying inflation, as you said, Tony, didn't really move that much. In fact, there's some suggestion maybe it has actually peaked or come back slightly. I guess the real question that we want to ask is, what's the RBA likely to focus on? So let's talk about that maybe for a second, Tony. If you're an RBA board member, what number is going to matter more to you right now? Is it the 4.6 headline inflation or the 3.3% underlying inflation figure?
That's a good question. You probably need to look at them both, but the 3.3% underlying inflation is important.
That's their preferred measure, isn't it?
Correct.
Yeah. So now 3.3% is still above the 2 to 3% target band that the Reserve Bank has. And I think one of the areas that they'll be focusing on is whether they perceive what we're seeing, which is that peaking and gradual easing in the underlying inflation, stripping out all the noise with what's going on, or whether they feel that that's still too sticky. It is still above the target band. So is it coming down? Is it in control well enough? How persistent is that underlying inflation going to be? Is it going to still stay sticky above the 2 to 3% band moving forwards? And the other part of it is you can't ignore, can you, what's going on with the Middle East conflict and what that's doing to petrol prices, and the fact that even if you strip out the petrol prices themselves when you're measuring inflation, they still flow through into everything else, don't they? So, part of the reason why construction costs have been going up at the moment is, well, you have to get things from A to B. You have to ship materials to site. That uses fuel. And if that cost of transport's gone up, then you pay more to get those materials on your site. Plastics, things like plumbing supplies, PVC pipes, use petrochemicals as an input. So they've seen like a 30% plus jump in recent weeks in cost. So you can't avoid taking into account what's going on. I think the Reserve Bank is going to be concerned about, well, how much of the inflation that we're seeing in things like fuel prices is going to spread into the prices of the rest of goods and services and potentially cause an issue with the underlying inflation figure as we move forward.
Yeah. So, I mean, the other part of this is it's how long this war is going to last, which will continue sustaining these current price points. And we all know that even when hopefully the war gets settled down and things return back to normal, pricing typically doesn't return back to what it was before.
Oh, no. And it's going to take months. Like, even if you opened the Strait of Hormuz tomorrow and got ships back up to the same volumes in terms of transporting oil and so on, there's a lot of damage that's already been done that will take months to unwind and to get back to normal. So in the meantime, you've got, elevated fuel prices. They won't suddenly just drop like a stone overnight. They might come back a bit, but they won't necessarily go back to where they were. And so there's the downstream impact then of those costs flowing through into everything else. We could see this hanging around for quite a while. And I think that leads into one of the other concerns. It's a less tangible concern that the Reserve Bank has, but it's one about expectations. What do we think as consumers is going to happen with prices? And they have a concern that if we believe collectively that prices will keep going up, then collectively we might seek to get wage increases to compensate.
Yeah.
And then if we get wage increases that have compensated, we go out and keep spending. And then that becomes this vicious cycle of what they call a wage price spiral of, I want more wages because prices have gone up. I get more wages. I go out and spend that. Prices keep going up because the demand's still there. The counter to that maybe is that this is not a demand-driven inflation issue at its core, in my opinion. This is because we've got supply side shocks like the oil shock, and you've got things like scarcity of housing and scarcity now of certain materials like plumbing supplies and so on. You can kill demand, absolutely, but that doesn't fix the problem. So there's a real challenge that the Reserve Bank's facing with the tools at its disposal. Thinking forwards into next week and knowing what we know about the data and the underlying inflation and what's driving things at the moment, arguments to raise rates next week versus potentially arguments to hold. And is there a balance or a difficult balance that the Reserve Bank might have to make there? Because right now, the money markets are still anticipating odds in favor of a rate rise of 0.25% next week. But they did become less certain about that after the inflation data came out earlier this week. In fact, that probability was, before the ABS data came out, that probability was 85% in favor of a rate rise. That's dropped down to almost 75% now. So it has come back a little. Still weighted in favor of a rise, but not as confident about a rise happening as they were. If I was the RBA, why might I hold rates, Tony? Well, I think the primary argument is, well, underlying inflation is still above the 2 to 3% band. Maybe it's not coming back as quickly as possible, and maybe these risks in terms of the fire spreading because of the fuel crisis at the moment, the risk is that it stays above that 2 to 3% band for longer, or potentially goes up rather than holding where it's been holding at the moment.
In my mind, Simon, I think it's the duration of the war. So the longer it drags out, the RBA is going to look at that and go, well, how do we contain this thing? And the answer would be, let's put it up by another 0.25.
And if you look at it in isolation like that, and the tools at the Reserve Bank's disposal, typically what they do, if they see an inflationary issue, it's, okay, what do we do to suppress demand? The challenge here, obviously, is that, we can't easily suppress demand for fuel. It's kind of a critical necessity. And you can't easily suppress demand for essential goods, things like people needing a roof over their head, so renting, for instance. That's very difficult to fix with interest rates, but maybe we can crush demand in other parts of the economy to bring down overall inflation by suppressing the consumption of other goods and services that aren't so much these essential ones that have got the supply side issues at the moment. So that could be the argument. The other part of it, coming back to that less tangible concern about inflation expectations, is that the Reserve Bank, in the recent decisions to put up rates back in February and March, has expressed concern that they don't want expectations to become unanchored so that people think that prices will keep going up. They want to look at that and go, okay, what can we do to demonstrate a commitment to getting inflation back down? Will the public see that we're committed to that, and therefore the expectations of the public are that inflation won't stay high forever, that it will come back down later because they can see that we're acting to suppress demand in other parts of the economy, blah, blah, blah. So I think those are the arguments that we'll see put forward in favor of increasing rates. But what about the other side? What might make the Reserve Bank hold? And I would argue that, well, underlying inflation in the last 3 quarters has not been getting worse. It's in fact been trending lower quarter on quarter, as we can see in the data. And also that the increase, or if you were to increase rates, is that really doing anything to address the underlying causes of inflation, or are they still going to be there no matter what you do in that instance? And is that still going to feed through into increasing prices? So they'll probably be debating whether, can we do enough to slow down the rate of increase in prices by putting rates up, versus it's not going to have that great an effect anyway. So how effective is the tool going to be? And I think there's a growing concern at the moment about recession risk that will probably have to be debated by the Reserve Bank here. So the economy's already started slowing, and this fuel shock has caused a revision downwards of growth expectations right across the globe. So Australia's certainly not immune to that. We're quite vulnerable to that. If you suppress consumer demand further, if you suppress business confidence further by increasing interest rates, you might be compounding that risk and making it even more likely that businesses rein in their investment, consumers stop spending, that drives growth not just down, but into negative territory. You end up with a recession, and you start to see that reflected in things like unemployment.
Another thing, Simon, I think that when the Reserve Bank raised the interest rates last time, one of the commentary was that one of the underlying issues is government spending.
Yeah,
Government
correct.
spending,
And what have we got just around the corner, just in a couple of weeks from now?
exactly, right? And so my guess is government will want to impress people by giving them more stuff, and that flies in the face of managing the inflation again.
Yeah, and that is a risk. So, you get these contradictory messages coming out, and I guess we'll know in a couple of weeks, but you get these contradictory messages coming out, which on the one hand, we're talking about, well, we need to help with cost of living and all of that, which generally implies spending money or giving people handouts. And on the other side of it, it's like, well, we recognize that, we got to rein in spending in various areas. So, for example, what they're trying to do with the NDIS at the moment, rein that back. That uncertainty about what will actually be in the budget could in itself be a reason to just hold off doing anything with rates right now, so that the Reserve Bank actually has the opportunity to see what the final budget looks like and to consider, well, to what extent are there austerity measures in there that are reining in spending, taking money out of the economy that would help contain inflation, versus it's a big spend up that might then inject more money into the economy and actually result in more inflationary pressure. And I know the government's been criticised by the opposition for being a cause of inflation through some of the measures that it's put out there in recent times. But you don't have the budget yet. So is it prudent to just wait until you do have the budget to make a more informed, more responsible decision? And I think that should form part of the debate in the RBA as well. One other thing I think could come up very strongly in the debate inside the RBA next week is the point that, well, we've just had 2 rate rises. We had one in February, we had one in March. Monetary policy doesn't impact people's behavior or pricing or inflation overnight. It takes months to actually flow through. So they simply haven't had the chance to see what the impact of those first 2 rate rises this year actually is on consumer behavior and inflation already, other than we can see that consumer sentiment is suppressed, business sentiment is suppressed, and you would expect that to translate into behavior as well if you're thinking about expectations moving forwards. But I think that's a very strong argument on its own to say, well, you've got to see what the impact of those first 2 moves has been before you really consider compounding it with yet another move, because especially with the risks to the economy, potential recession risk, the fact that you are dealing with a supply side shock, you've got uncertainty about how long the war is going to go for and how long that's going to persist. Maybe you need to give it a bit of time to see what the first 2 rate rises are actually doing in terms of helping to contain inflation and helping to contain people's expectations. The guys on the session live today, put into the chat what you think the RBA will do. Do you think they'll raise? Do you think they'll hold? Do you even think they might lower rates? We'll do a quick snap poll now before we wrap up. Just let us know in the chat what you think, and we'll do a quick tally. While people are doing that, we obviously have the results get-together coming up in Melbourne on the 16th of May with everything that's going on here, the rates decision next week, the federal budget in 2 weeks from now. That is going to be a really big, important event to be in touch with the market and in touch with the emerging opportunities, the trends that are changing, our latest forecasts on where the property market is going. So results members, if you have not yet RSVP'd for the get-together, make sure you do so ASAP, lock that in, organise your travel, and be there on the day. It's going to be phenomenal. For our new members in the real estate success community as well, welcome aboard. Great to see you here. I hope you're enjoying the Fireside Chat. Make sure that you have set up your profile. That's really important, isn't it, Tony?
It is very important. It's a great way for you to actually meet other people online. And so the more you tell people about who you are, what you're up to, what you want to be doing, the more people can then associate it and reach out and say hello and welcome to the community, but also have a private conversation if need be.
Exactly right. It's a great way to build your network, be seen. Other things to do, make sure you answer the icebreaker question. Again, that also makes you visible in the community, and ensure that your notifications are on so that you're getting reminded about events like these. Make sure you RSVP for the upcoming events in the upcoming event space so that you've got your finger on the pulse, so to speak. Let's have a quick look at the poll, Tony. We've got raise, hold,
Raise,
0.25 up, raise, hold, rise, will hold, rise. I'm hearing the vibe as they may hold, rise, raise, hold. Hopefully they'll hold the rate until there's some clarity regarding the oil crisis. There are strong arguments on both sides. I think this will be a bit more line ball than what the money markets are currently predicting. I think it's closer to a coin toss. At the last RBA meeting, remember the decision to raise at that point in time was a split decision with only a 5-4 majority in favor of raising at that point in time. So it wouldn't take much for one of those 4 who thought we might raise at some point, but let's not do it now, we'll do it later. Now you've had the raise. It could very easily be that just one more member goes, you know what, with the raise that we have had, maybe we don't need to raise again this month and give it a bit of time to see what works through, wait for the budget and so on, and get a bit more data before we move again. I think it's much closer to a line ball decision than what the money markets think it is, but we will see next week, and no doubt we'll circle back and have a chat about that once the decision's out, and certainly we'll unpack it at the get-together for the results members. Final thought, the market hates uncertainty, and there's a lot of uncertainty around at the moment, but for us as more sophisticated property investors, we want to embrace that uncertainty because that opens up opportunities. When you lose certainty in the market, people freeze up, they don't know what to do, so they do nothing. That's when the more disciplined investors have the edge. And that's who we want to be. Guys, that takes us to the end of Property Pulse for this week. We'll be back again next Thursday, same time, same channel. Look forward to seeing you all there. Thanks for joining us today, and we'll catch you all again soon. See you, everyone.
Bye-bye.